Sam&Cents. Money that finally makes sense. If you've ever told a car dealer, I can do $500 a month, this story is about you. That sentence feels like budgeting. But some buyers and some dealers end up staring at that one comforting number while the price, the loan term, the add-ons, and the total cost drift out of focus. Not in every showroom, but when it happens, it's expensive. And here's the strange part. A payment plan helped General Motors overtake Henry Ford, the man who put America on wheels and who spent years refusing to sell his cars on debt. So how did a sewing machine payment plan end up helping to beat him? Stay with me, because at the end I'll show you a payment that falls by about $146 a month while the same loan gets about $2,500 more expensive, and the 5-box checklist that protects you. First, picture a scene. It's an illustration, not a hidden camera recording. You've been at a dealership for 3 hours. You said $500 a month when you walked in. Now a salesperson slides over a sheet with one number circled, $499. Relief, it fits. But ask what made it fit. If the payment came down because the price came down, you won. If it came down only because the loan got longer, same price, same rate, same car, then the total you'll pay went up while the number you were watching went down. That's the trap this whole story explains. Because here's the reframe: the monthly payment is not the deal, it's the output, the number a calculation spits out after every real decision has been made. The inputs are the price, the taxes and fees, your down payment, the amount financed, the interest rate, the number of months, whatever happens to your trade-in, including any old loan balance rolled forward, and every add-on in the finance office. Move any input, and the payment moves. Watch only the output and you can't tell which input moved. And people discovered how powerful that little number is more than 150 years ago with a sewing machine. Installment plans are old, older than this story. Nobody in this episode invented the idea of paying over time. But around 1856, Edward Cabot Clark, the business partner behind the Singer sewing machine company, introduced a plan the world noticed: hire purchase. A family could rent the machine and the rent counted toward owning it. That mattered because a sewing machine was a serious expense for a working family, but it could save enormous amounts of hand sewing time. Clark's plan turned one impossible price into a series of possible ones, and Singer's role was scale. The company helped popularize hire purchase for a mass-produced household machine. Did it work? A Harvard Business School historical exhibit says that after Singer rolled out its innovative credit plan, sales nearly tripled in a single year. Careful though, a lot was changing at once: the company, the product, the market, so history can't hand credit the whole trophy. And that famous hard sell slogan, $1 down, $1 a week, that belongs to the 1890s, decades later. What we can say is this: splitting a painful price into small pieces of time went from an experiment to an everyday way of selling things. And the biggest test of that idea was waiting in Detroit. In 1919, General Motors created the General Motors Acceptance Corporation, its own finance company. A business notice from that year lists 10 incorporated directors, among them John J. Raskob, one of GM's financial minds. Later scholarship credits Raskob and Alfred Sloan as the architects of the idea. And notice what the new company was actually for. Yes, it financed car buyers, but it put heavy emphasis on financing dealers and distributors, the loans that let showrooms keep cars on the floor at all. Credit wasn't just a consumer pitch, it was plumbing for the entire selling machine. Let's be precise about what that credit did, because it's easy to sneer at. It did not exist to trick people into cars they couldn't afford. It let a buyer who couldn't, or didn't want to, hand over the full cash price today, pay part now, and the rest out of future income. For millions of families, that was access, not a trap. Access and manipulation can live inside the same tool. Which one you get depends on whether you can see the whole deal. Hold that thought. Now, the giant who said no. Henry Ford's religion was the falling price. Build one car, build it relentlessly well, cut the price, sell it for cash. Ford publicly resisted installment debt, but the wall leaked from the start. Independent Ford dealers were arranging installment sales by 1914. Whatever the company's official posture, the market wanted to pay over time, and it kept finding ways to do it around him. In 1923, Ford finally answered, with a perfectly ironic misfire. The Ford weekly purchase plan put as little as $5 a week into a bank, and when you had saved up the full price, you got the car. Look closely. That's not credit. That's a savings plan wearing a payment plan's clothes. Drive now? No. Save first, drive later. The Henry Ford Museum describes the plan as unsuccessful for a simple reason. A customer could do the very same thing with an ordinary savings account. Ford had copied the shape of the weekly payment and left out the part people actually wanted, the car, today. So the retreat came in stages, and the dates matter. By 1914, independent Ford dealers were already offering installments. In 1923 came the corporate savings-only plan. By 1925, Ford dealerships were offering a weekly credit plan with immediate delivery. Drive now, pay as you go. In 1928, Ford created the Universal Credit Corporation, real manufacturer-backed installment financing. Not the first crack in the wall, just the official surrender. And Ford Motor Credit, the finance company attached to Ford today, is a separate institution founded in 1959. Meanwhile, the scoreboard turned. In 1921, roughly half the cars sold in America were Fords. By 1928, Ford's share had fallen to under 20%, and General Motors had taken the lead. Did the payment plan do that alone? No. And this is where honest history beats a neat story. GM also offered more models at more price points, styling, annual model changes, and smarter production choices, while the Model T grew old in public. Installment credit was one powerful weapon in a full arsenal, but it was the weapon Ford refused to pick up for a decade. The payment plan didn't beat Henry Ford by itself. It helped. Now, the bridge to your money, and I'll mark it honestly, this is an analogy, not a bloodline. Nobody in 1856 or 1919 was running psychology experiments. They were salespeople who noticed what worked. And there's no unbroken chain of custody from Clark's hire purchase ledger to the payment slider on a car website. But the rhyme is loud. Singer sold a machine as pennies of rent. Ford's plan bet that $5 a week sounds friendlier than $600. And today's car configurator greets you with a monthly number before you've seen the price. Small number first, big number later, if you ask. And the numbers say the small number era is still growing. Federal Reserve researchers analyzing Experian data on auto loans opened in 2023, new and used, found the most common loan term was 72 months, 6 full years, and roughly 12% of those loans ran 84 months or longer. Experian reported that in the first quarter of 2026, 35.55% of financed new vehicles carried terms longer than 6 years. Longer than 6 years. Not necessarily 84 months exactly. When a term stretches while you watch only the payment, the extra years can hide in plain sight. So let's drag them into the light. Here's our illustration. One loan, 2 clocks, every assumption on screen. A car costs $34,000 out the door. You put $3,000 down, so you finance $31,000. The loan is fixed and fully amortizing with no fees in the math at a 7% nominal annual rate, charged monthly. Same car, same money, same rate. The only difference, clock 1 runs 60 months, clock 2 runs 84. At 60 months, the payment is about $614, and all the payments together come to about $36,830. At 84 months, the payment drops to about $468. Using the unrounded payments, that's $145.96 less every month. It feels like winning. But the payments now total about $39,301. In this no-fee model, that's about $2,471 of additional interest, plus 24 extra months of owing money on an aging car. The payment got smaller, the car got more expensive. That is the lever in numbers. So here is your defense. This video's 5-box checklist. Not a law, not an official industry procedure. An order of operations we built for this episode. Box 1. Your budget. And that means total ownership cost. Payment, insurance, fuel, maintenance, registration, repairs. Decide your ceiling at home. Many buyers choose to keep that ceiling to themselves until the real numbers are on the table. That's a strategy, not a rule, but it keeps the conversation about inputs. Box 2. Before you visit a showroom, collect financing offers from a bank or a credit union, so any dealer offer has to beat a real number. Box 3. Ask for the out-the-door price in writing. Vehicle, taxes, mandatory fees. Before financing and before the trade-in, enter the conversation. That's a recommended sequence. not a legal requirement, and here's why it earns its place. A seller who knows only your ceiling can work backward from it toward the most expensive deal that still slips underneath. Not every seller does that, but you can't tell which kind you've got, so the checklist assumes nothing. If a discount appears, ask whether it depends on dealer financing or any other condition. Box 4. Compare loan offers at the same amount financed and the same term. Otherwise, the payments aren't comparable at all. Box 5. Everything else separately. Treat the trade-in as its own sale. Write down the exact payoff on your old loan and the exact value you're offered. If you owe $4,000 more than the old car is worth and you roll that into our 84-month 7% illustration, it adds about $60 a month and about $5,071 in total additional payments. Price every add-on in dollars before it enters the loan. A $3,000 package in that same loan adds about $45 a month, but about $3,803 in total additional payments. Then read the federal disclosures, the annual percentage rate, the finance charge, the total of payments, and the payment schedule. And when the room drifts back to, so what monthly payment works for you, use the reset sentence. It's a request, not a legal demand. The law guarantees those disclosures before you sign, not necessarily in the first conversation. Say, I'm not choosing a monthly payment yet. Please show me the out-the-door price, amount financed, annual percentage rate, term, finance charge, and total of payments. One honest caveat: sometimes the longer loan is the right call, a conscious trade of more total interest for monthly breathing room a family genuinely needs. That's not failure. The only failure is making that trade without seeing it. A century ago, a man who hated debt lost his lead in the biggest market in the world, in part, to a rival who understood one thing: people decide with the small number and live with the big one. You can't change that history, but you can walk into the room as the one buyer who looks at both. And now that you can see both numbers, there is one more pair to separate: the score a lender sees and the life you are actually building. Next time, we'll split the scoreboard in two: what a credit score actually tells a lender, and the numbers that tell you whether your own financial life is getting stronger. Same channel. Bring both scoreboards. So there it is, small boring moves that quietly win. If your money makes a little more sense now, hit subscribe to Sam&Cents. And the next one's right here. It picks up right where this leaves off. See you there.